The Mayan apocalypse, no destruction, but a belief in something bigger than us. Today, instead of pyramids, we have cliffs, and politicians looking to the skies for answers. John Boehner today on reaching the fiscal promised land, quote, how we get there, God only knows. Let's talk to David Gaffin. He is Reuters markets editor. David, how we get there, God only knows.
Yeah.
now, plan B, John Boehner, dead in the water,
exactly.
right? Now, do you think that the politicians and the economy was too hopeful about this deal and that this is a day where the market's recalibrating itself?
Yeah, I mean, the market had certainly gotten it into its head that everything was going to be okay.
Right.
And this deal was dead on arrival. The White House would not have passed it anyway. But the fact that the Republicans wouldn't get together on even the most minimal of tax hikes turns out to be very bad for the markets because they've said, well, how are they going to get any deal done?
That's
now
right.
We're going over the cliff. So we're down 1.5% area.
Over 1% across the board.
It's been a tough day as the markets kind of rethink things a little bit. You talk to people and you still hear a lot of optimism because that's just the nature of stock investors. But again, there's just still, we're rethinking things just a little bit here.
All right, talk us through the E-mini futures flash crash that happened last night. Dropped about 15 points a second.
Yeah, well, it's not, you can't see it by minute on this chart, but what ended up happening is that when this all came out, we were down about 30 points all at once. And the E-mini futures are the most popularly traded futures contract. They're basically the S&P futures, but they're 1/5 of the size.
Right.
So more and more people trade them.
Right.
And what happened is that in the span of a second, and the trading data shows this, we dropped from about 1407 to 1392. And it's all within the span of 1 second. This is a flood of orders that came in.
Right.
And eventually, the order book just sort of ran out of orders. So the CME stopped trading for 10 seconds. Now, this thing almost never stops trading because there's always enough orders out there for them to be filled. But at this moment, there wasn't. And it was just kind of scary. So the whole move was about 3.5% in the span of a couple of seconds.
Wow, amazing.
We've recovered, as you can see,
we have,
somewhat.
Right, somewhat. All right. Let's take a look at banks because among the hardest hit today, and you can see everybody's Bank of America down over 2%, Citigroup down almost 3% there.
Yeah, well, whenever there's a fiscal-related issue and some uncertainty about where the economy is going, people sometimes take their frustration out on the banks because, they are supposed to be, symbolic of economic growth and lending and banking activity. And so, of course, they're getting hit harder today, and that's kind of where we are.
Right, as we look at the S&P financial sector there.
Right, exactly. I mean, the sectors have been doing well overall because of this expectation that everything's going to be okay. And housing data looks pretty good, and consumer data looks pretty good.
Right.
But we just don't know, and that's why we see these sort of mini flash crash things, and that's why as long as this lingers, and it will linger, we're going to see some of these kinds of events. It's not going to be easy.
Talking about consumer spending, for November, it's highest in 3 years.
Yeah, exactly. I mean, this is a volatile figure. It goes up and down month to month. But again, the consumer has been reasonably hanging in there now that the housing market has improved and people feel a little bit better about situations in general. So that's a good number, and that's another takeaway that, the economy is improving. It's going slowly. It's picking up. But the main issue, of course, now is the Washington, dickering and bickering.
All right, let's go back to some bad news. Let's talk energy, and let's look at some crude futures for February, which fell more than $1 an intraday low.
Right. I mean, that's, again, part of this sort of, very quick move away from assets that are supposed to be riskier, so that are associated with growth, like oil stocks and the euro and things like that, and that's why. And as you can see, they're still not at the lows we saw within the last couple of months, but that's part of what's going on.
And the energy sector as well, we can show as a whole for the S&P. Safe havens, though, the dollar, of course, and the 10-year Treasury.
Yes, exactly. I mean, this was a knee-jerk kind of reaction. The bond market has, of late, yields have been rising because people are, starting to think, well, if the stock market's doing well and growth is going okay, yields need to be higher, and we don't need to bet so much on this safe haven because we're so afraid of everything. Well, that's turned around today because we're back in being afraid, and so they're moving back into the dollar, they're moving back into gold, and they're moving back into Treasury bonds.
Right. Okay. And speaking of gold and gold futures, do we have that up there? Let's just take a look. Ticked up a little bit today.
Yeah, exactly. And you can see that the way this chart is going, that gold has been on the decline as this sort of big premium that people had about the end of the world, the Eurozone crisis, whatever it is kind of been pulled out of the market in the last several months. So it's ticking back up today because, again, it's a fear trade.
Yeah. All right, so sum this up for us looking ahead to 2013. I mean, this is a rough day, but as you said, consumers hanging in there. What do you see going forward?
Well, a lot of this sort of depends on what happens. Now, if you accept the idea that we go over this cliff, or really it's more like a slope, because on January 1st we're all going to wake up and be alive, and get our coffee and go to work.
Won't be the Mayan apocalypse
exactly,
then,
exactly, unless it's developing very slowly.
Yeah.
So we're all going, this isn't like we're defaulting on our debt tomorrow. Right. Everybody is going to continue doing what they're doing, but you'll start to see tax hikes take a hit, and these things will slowly work their way into the economy. So if you see no deal by the middle of January, by the end of January, where they don't cut some taxes, reduce some of the spending, do some of the work that needs to be done, then you could see the economy take more of a hit if they just go over the cliff and, okay, we're done here kind of approach. Right. So, but it will take time. But for the most part, I would think the market would continue to do okay because of economic stuff we've talked about.
All right, well, Congress in recess until at least December 27th.
Sure, so they can't do anything bad till then at least.
Nothing bad until then.
No,
that's a good way to look at it.
Yeah.
All right, David Gaffin, thank you so much.
Thanks a lot.
Remember, everybody, follow us on Twitter @Reuters Insider and check out our YouTube channel, Reuters.com/Reuters TV. I'm Lisa Bernhard. This is Reuters.